Hey listeners, it's Paul Andreola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Okay, so CANSLIM. Hopefully, well, I don't know how many of you have really heard of CANSLIM before, know it, agree with it, disagree with it, whatever. But this comes from the book How to Make Money in Stocks. And when I really when I really got to understand it and apply it, it really changed my financial life. And I don't mean this lightly. It is a wholesale shift in what I was taught as an investor early on, right? The whole concept, first off, of buying low and selling high, I think that's what everybody kind of looks for or is striving for. But realistically, that that will make you an average investor. If you want to be able to find companies that are going to make you, sort of life-changing wealth, you have to think differently. You have to think differently than the average investor that's out there or the crowd. And this book did that for me. When you add things like, Reminiscence of a Stock Market Operator, when you add books like, How to Make $2 million in the stock market, even when you add, Benjamin Graham, when you add, what's the other big one? Peter Lynch. Anyways, when you add those things all together and you take this to heart and understand why this works, it will really, it'll improve your ability to find those stocks that give you 10x, 20, 30x potential, right? You will rarely find a 10 or 20xer in the value pile, right? You've got to find things that are consistently sort of commonplace in these multi-baggers, like the Amazons, like the Googles, like the Microsofts, like the Starbucks, like that, and you can go on and on and on and on. These companies that return 10,000% and higher. CANSLIM will help you find those, okay? So what I was hoping to do is, just go through a couple of these letters. What does CANSLIM actually stand for? What are you really looking for? Why does this sort of stuff work? And again, if you haven't read the book, please read it. At the very least, it will make you think a little bit differently, which I think is going to help. You can disagree or agree with it, but I think you will be able to get value out of reading this book. Okay, so let's jump into it. CANSLIM. The C in CANSLIM stands for current quarterly earnings. So this is one of the things that Trevor and I do every night is we go through CDAR and we're looking for financials. We're going through financials and we want to see, well, quite frankly, it's not even the first thing we look at, but we do want to eventually see earnings that are growing at 25% or higher. Okay, so earnings per share that are growing at 25% or higher from the same period last year. So Q1 versus Q1 the year before, if the share or the EPS, earnings per share, is higher by at least 25% or greater, then the stock now is in the sort of, it passes through to the next check mark, right? It sort of is, on to the next level. The important thing there too is that watch out for companies that are growing through M&A or buying their business, because you end up seeing an expansion in the amount of shares outstanding more times than not. And even though the earnings are growing by 20%, your share of the earnings aren't necessarily growing by 25% or more. So it's important that you look at quarterly earnings on an earnings per share basis. All right. So that's the C. Okay. Now the A is the earnings on an annual basis. So ideally you want to see same thing. So you might have a quarter.
Paul, it's Brad. Sorry to cut you off. Russell's just asked if you can let him back in.
Oh,
he stepped away and he just
well,
tweeted me and asked if you could let him back in. Yeah. Thanks, Trevor.
You got it. Let's see if the man's back in. Is he back in? All right. I'm going to assume he's back in now. Okay. Okay. So annual earnings growth. So same thing. You want to see, well, the more of these things that you have in place, the greater your chances of seeing something that's going to have consistency and growth. So you want to take what I do typically is I take the trailing 12 months earnings and I compare it to the previous trailing 12-month earnings. And if it's growing at 25% or more, bingo, another check mark. Now, what they haven't mentioned here, and I look for, in addition to that, excuse me, let me get some water here. So the other thing we look for is we actually look for revenue growth as well. So the very first thing that Trevor and I look for when we're looking through CDR filings and Edgar filings is 25% revenue growth. If you're getting 25% revenue growth, there's a very, very strong chance you're going to see levered earnings growth. So so quite likely you're going to see more than 24% earnings growth. But the more quarters of growth you see, and the more annual earnings growth or more years of growth you see as well, increases your chances. It basically increases the data points that are giving you that trend information. The trade-off is, usually if you have a company that's been putting together real strong numbers for like 6, 7, 8, 9 quarters in a row, there's a greater chance it's already been discovered, right? So if you see a company that's put together 2 back-to-back quarters of earnings growth, it's less likely to be discovered than one that's put together 10, right? So for us, Trevor and I, our cutoff is really 2 quarters. We want to see at least 2 quarters of back-to-back revenue growth and earnings growth over those levels to really give us a confidence that this looks like it's going to be like on the A list, right? There's a lot of times we're going to invest in companies that may have only put 1 quarter together, or maybe it was 23% growth, not quite 25%, but it's not quite an A stock, right? It falls down, and we tend to follow it closely in hopes that it gets another quarter, or it accelerates its revenue growth and things like that. So that's why some of the stocks in the portfolio aren't necessarily like these classic A stocks. But when we do find one like a CPRO, we get pretty aggressive. We say, okay, time to really go and we quite frankly get more aggressive. So okay, so the N now, this is one, if you notice in the interviews I do, I always try to find out if there's a new product, a new service, a new initiative. Sometimes it's new geography, but the word new tends to be very important because usually that's the driver of the acceleration in any sort of revenue or earnings growth. So this N becomes quite important, and it's usually why you see this, this business sort of go from a 10% grower to 25, 30% growers because they've launched a brand new product, they've launched into a new market, they have a new salesperson, they have a new director, they have something new, right? So you're really, really trying to find, especially with microcaps, try to find out what is new and what could be the catalyst for that change or that inflection point in the business, all right? So S is another one, good one that we try to follow as close as we can, but you want to, S stands for supply. So supply in this case is supply and demand of the shares. The lower the supply and the higher the demand, obviously the higher the share price has a tendency to go. So historically, this is a very odd statistic that I still haven't really really grasped, but have come to understand more and more over time. Surprisingly enough, like if a company has less than 50 million shares outstanding, they have a higher propensity to be a profitable company than a company that has more than 50 million shares outstanding. We think the reasoning for that is because shares are like anything. They're a resource, they're a currency, they're an asset, they're something of value. And if you have a management team that are very sort of smart with their shares, right? They're good allocators of their shares. They're very likely to be good allocators of other resources that they have, right? So you can find a lot of companies that have 200-300 million shares outstanding. And yes, you can find a lot of them that, there's still some that are profitable with that kind of amount of shares outstanding, but they don't tend to be as profitable as a lot of these other companies with the smaller float out. Now, that's why we think there's that connection between profitability and lower share count. But at the end of the day, it sort of almost doesn't matter. Why it matters more to you should be the fact that it's, again, supply and demand. And it's not just about how many shares are outstanding, but it's also about who owns those shares, right? So again, one of the questions we always ask is kind of what's the insider ownership? And then we try to get an understanding of who else owns the rest of the float. So if you have a company that's got 25 million shares outstanding and 10 million of that is owned by insiders, and then you find out another 10 million of that is owned by very strong shareholders. So it could be institutional, it could be high net worth individuals, it could be one high net worth individual that owns the majority of it. Now you've got a very, very small float, very, very low supply. And then if the company executes or does something good, the demand is going to be driven into a very, very short amount of supply. And that's when you get these really explosive moves, right? So we spend a lot of time really trying to understand that S, or share count, and figure out what the supply and demand looks like. And it's why when we see a company that's got, you know, a couple 100 million shares outstanding, it's not necessarily we say, no, that's a no-go and it's a deal breaker, but it kind of lowers the quality of the company more so than a company that's got, you know, 25 or 30 million shares. I mean, I'm almost exhausted by using this as an example, but XPEL, when I first found XPEL, it had 26 million shares outstanding. That's when the stock was around 20 cents. And I believe now it has 29 million shares outstanding, and it's got $1.5 billion market cap. The way that management team treats its shares is the same way it treats all the other resources it has at its disposal. And you can see why it's been able to go from 20 cents to, you know, recently it hit $80. So you're looking for that S, you're looking for that situation where if things really do go right, your ownership, you know, your share of that business is going to be in a lot more demand than is available in supply, and you're going to see a higher share price. Okay, so L, leader or lagger. Okay, so this is why things like the sector strength becomes important. So you want to constantly be investing in the leader, whether it's the sector or whether it's the player within the sector. About 50%, sorry, I think the statistics around 37% of the direction of a stock is dependent on the overall sector that it's in. Another 13% is the subsector it's in. And then about 50% is actually the execution by that business. So about 50% is determined by things that aren't necessarily driven by the company itself. So you want to try to get as much sort of directional help from the industry it's in, the subsector, and of course, when you find that strong subsector, you want to try and find the leader within that category. So a lot of times the big winners that we've had in the past are companies that aren't necessarily going after a large market. They're not, you know, 2% of a gargantuan market. They lead, or they sort of dominate a niche market. So if you look at XPEL, XPEL was arguably that whole sector was probably at its, you know, when I found it, probably worth $200 million. And they were one of the leaders. Now there was 3M, and they were kind of going neck to neck, right? So, you know, over time, they're clearly the leader now in that sector. But if you look at other subsectors, if you look at other niches, you want to find businesses that, you know, might have 40, 50, 60% market share of a sector. It allows that company to maintain very high margins because there's very little competition. And it doesn't, the market is sort of small enough where it doesn't encourage other outside players to come in and try to move them out of that space. So if you think, imagine a company starting up now and trying to displace, you know, some of these players in these massive industries, whether it's, you know, search engine or maybe retail or anything that's got, you know, these big behemoths that are playing in it, where these big players will crush you to try to get a 0.5 percentage point of that market share. You know, to be able to compete in that market, you're just going to, I mean, you're going to have to slash margins. You're going to have to be, you know, you're going to have to spend a lot of money to kind of grind and get that. I'd much rather see a company that dominates a niche and allows that niche to grow. And more times than not, what happens is once they've dominated that niche, there's a sub niche or an additional niche that they sort of get involved with without having to compete against massive players. So you want to be a leader within that niche. You want to be investing in a sector that's starting to lead. You always want to be involved in a leader rather than a laggard, whether it's a sector or whether it's, you know, the specific company that's in there. Okay, now I stands for institutional sponsorship. Now this is where I don't really follow the CANSLIM sort of process to a T. What they typically recommend is they want to see, you know, you buy a stock that has institutional sponsorship, meaning there's institutional ownership right now, and that institutional sponsorship is going to help drive sort of the capital awareness or capital sort of stewardship of the business. If you've got an institution that has a meaningful position in that stock, the theory is that they're going to go out and tell others. They're going to go and brag about that stock. People are going to see their holding in their quarterly reports, things like that. What I find is that if you really want to get maximum sort of returns on these things, you want to step in just before those guys buy. And you have to really understand what these companies or what these institutions are typically looking for. And if you can do that, you can position yourself ahead of these groups, and then you just sit and wait, right? And it's easier than you think. So what I try to do is I actually try to look for very little institutional ownership, and if any at all, especially when you're dealing with Canadian companies, because typically if an institution already owns that stock, it's discovered for the most part. It is likely it's likely been mentioned somewhere. It's likely that more people know about it, and you're not going to get the same mispricing. But if you can be fortunate enough to buy before these guys do, it's amazing how much it changes the direction and the sort of the trajectory of the stock. So I look for low institutional ownership if any at all. Okay, so that's the I. And then lastly, M stands for market direction. I think this is pretty clear. You're gonna do better investing, going along in a market when the whole market is going up, right? So the M really is around trying to understand the general direction of the market. So if you look at it now, again, my belief is that we're at the very early stages of a brand new bull market, and we still don't know exactly what is going to be the major driver of that bull market, but we're seeing certainly bull characteristics within the life science space. So if you can really understand the direction of the market, then you should have higher confidence in the investment you're buying. So if it meets all those criteria and you have the market going the right direction, the odds are very high that you've got a winner. And if you can find a winner in these type of companies with this sort of hyper growth, it is remarkable the kind of returns you're going to see in these things, especially when they go from undiscovered to discovered. All right. So that kind of covers it there. I mean, some of these quarterly earnings that we're starting to see here are not, we're not talking 25, 30, 40% earnings growth. We're seeing 150 to 200%. Those are Bowflex, those are XPEL, early XPEL type numbers. Those are 100 to 150% returns a year type of companies when you start to see companies that are generating that kind of return. So that's kind of what the expectation is here is we want to find those companies that are going to be able to double and triple in the span of a year, and quite frankly, have the ability to do that for 3, 4, 5 years in a row.